Right now, in 2026, there is extra money sitting on the table for millions of American seniors. A bigger Social Security check, a brand new $6,000 tax deduction, and a rule change that lets you work more without losing your benefits. But here's the part that should worry you. Most seniors will never claim all three. Some will actually end up with less money than last year, and they will have no idea why. I'm June. For more than 20 years, I have helped American retirees protect their benefits and keep the money that is rightfully theirs. And in the next half hour, I am going to walk you through all three of these changes, exactly what they say, exactly who they help, and the simple steps you need to take to make sure not $1 slips past you. Stay with me all the way to the action plan near the end, because that is where I show you the one mistake that even careful, rule-following seniors are making right now. It is quietly costing some of them hundreds of dollars a month, and almost nobody is talking about it. So pour yourself a cup of coffee, sit back, and let's go through this together. Slowly, clearly, the way it should have been explained to you in the first place. Let me tell you about Robert. Let me start with a story. It's about a man I'll call Robert. Robert is 68 years old and he lives in Ohio. He worked his whole life. He was a maintenance supervisor at a school district for over 30 years. He retired, he started his Social Security, and he did everything by the book. In January of 2026, Robert heard the good news just like you did. Social Security was going up, a 2.8% raise. Robert did the math at his kitchen table. His check was about $2,000 a month, so he figured he'd see roughly 56 extra dollars landing in his account. He was happy. He told his wife they could finally cover the rising cost of groceries. So the payment hits his bank account, and Robert checks it. And the raise is there, but it's smaller than he expected. A lot smaller. He sat there confused, thinking the government had made a mistake. He even started writing down questions to call somebody about it. Here is what Robert didn't know. On that very same check, his Medicare Part B premium had gone up. It jumped from $185 a month to $202.90. That's almost $18 a month, taken right out of the top of his Social Security payment, automatically before he ever sees it. So that $56 raise he was counting on, about a third of it vanished before it hit his account. Not because of fraud, not because of a mistake, because that is exactly how the system works, and nobody sat Robert down to explain it. And the most painful part? Robert almost wasted a whole afternoon and a long phone call fighting an error that was never an error at all. He just didn't have the full picture. And Robert is not alone. This same confusion hits a huge share of the nearly 71 million Americans who receive Social Security every single year. The raise is announced loudly on every news channel. The Medicare deduction that eats into it happens quietly, in the fine print. That gap between what people expect and what actually arrives is where the stress and the mistakes live. So let's make sure you are never caught off guard like Robert. Let's break down all three changes, one at a time. Change number one, your bigger Social Security check. Here's what the Social Security Administration actually says. Starting with the December 2025 benefit, which is the payment you received in January of 2026, all Social Security and SSI benefits went up by 2.8%. This is called the COLA. That stands for Cost of Living Adjustment. In plain English, it's a yearly raise designed to help your benefits keep up with rising prices. You don't apply for it. You don't fill out a form. It happens automatically. Now let's talk real numbers, because that's what matters at your kitchen table. The average retired worker's check went from about $2,015 a month to $2,071 a month. That's about $56 more a month, or roughly $672 more over the year. For an older couple where both people receive benefits, the average went from $3,120 up to $3,208 a month. And if you're a widow or widower living on your own, the average went from $1,867 to $1,919 a month. If you happen to be receiving the maximum benefit at full retirement age, that climbed to $4,152 a month. So that's real money. That's the good news. But now here is the part that most people, including some financial advisors, get completely wrong. A raise can actually leave you with less spending power than you had the year before. Let me say that again because it sounds backwards. you can get a raise and still come out behind. Here's why. That Medicare Part B premium I mentioned with Robert went up to $202.90 a month. And the Part B deductible, that's the amount you pay out of pocket before Medicare starts covering your bills, also went up from $257 to $283 for the year. And here's the kicker. Your COLA raise is calculated before Medicare takes its cut. So for someone with a smaller benefit, that Part B increase can eat up most of the raise. The number on paper went up. The money in your pocket might not have moved much at all. So what should you do because of this? Simple. Don't assume the full 2.8% landed in your account. Go look at your actual deposit and check the Medicare deduction for yourself. If something truly looks wrong, not just smaller than you hoped, but actually incorrect, you have the right to call Social Security at 1-800-77-21213 and ask them to recalculate it. You can also log in to your My Social Security account at ssa.gov to see your official benefit notice in writing. There's no penalty for an honest mistake on their end, and underpayments can be fixed once you report them. Change number 2, the brand new $6,000 senior deduction. This one is genuinely good news, and a lot of seniors don't even know it exists yet. Here's what the IRS actually says. Under a new law, if you are age 65 or older, you may be able to claim an additional $6,000 tax deduction per person. So if you're a married couple and you're both 65 or older, that's up to $12,000. In plain English, a deduction lowers the amount of your income that gets taxed. So a bigger deduction usually means a smaller tax bill. And here's what makes this one special. It stacks. It is in addition to your regular standard deduction. It is in addition to the extra standard deduction you already get for being 65 or older. And you can claim it whether you take the standard deduction or you itemize. It doesn't matter which way you file. Let me put numbers to it. A single 65-year-old who qualifies for the full amount can stack up around $23,750 in total deductions. A qualifying couple up to about $46,700. What does that mean in real tax savings? It depends on your tax bracket. But for many seniors in the 12% bracket, that $6,000 deduction is worth roughly $720 back in your pocket. For a couple claiming the full $12,000, roughly $1,440. Now, who gets the full amount? You get the full deduction if your income, and the IRS measures this with something called modified adjusted gross income, which is basically most of your income added together, is at or below $75,000 if you're single, or $150,000 if you're married filing jointly. Above those levels, it starts to shrink. And if you earn more than $175,000 single or $250,000 married, it disappears completely. So this is built mainly to help middle-income retirees. And now here is the part that most people, including a lot of folks online, get completely wrong. You have probably heard someone say, "Great news, Social Security is now tax-free." I need you to hear me clearly. That is not true. Social Security is not tax-free. This new law created a deduction. It did not eliminate taxes on your Social Security benefits. And I don't blame you if you believed it. Because here's the unbelievable part. The Social Security Administration itself sent out an email in July of 2025 that made it sound like federal taxes on benefits were being eliminated for most people. They had to issue a correction afterward, but the damage was done. The myth spread everywhere. The truth is, the rules for whether your benefits get taxed haven't changed. If your provisional income is over $25,000 as a single person or $32,000 as a couple, some of your benefits can still be taxed, just like before. Now, the good news within the good news is that this new deduction can lower your overall taxable income. And for some people, that might reduce or even erase the tax on their benefits. But that's a side effect. It is not the same as benefits being tax-free. One more important thing, this deduction is temporary. It runs for tax years 2025 through 2028, and then it's set to expire unless Congress extends it. So it's a window of opportunity, not a permanent fixture. So what should you do? Make sure you actually claim it when you file. It goes right on your regular Form 1040. There's no special application. And if you want free help, you don't need to pay anyone. The IRS runs free tax help for people 60 and older. You can reach them at 1-800-906-9887 or call AARP Foundation tax aid at 1-8882-277-6669. Both are completely free. Change number 3, work more without losing your benefits. This third change is a quiet win for anyone who is still working while collecting Social Security. Here's what Social Security actually says. If you take your benefits before your full retirement age and you keep working, there's a limit on how much you can earn before they start holding back some of your benefit. It's called the earnings test. And for 2026, that limit went up. If you're under full retirement age all year, you can now earn up to $24,480 before any benefits are withheld. That's up from $23,400. And if you reach your full retirement age sometime in 2026, the limit is much higher. $65,160, counting only the months before you hit that birthday. In plain English, this means you can work a little more and keep more of your check than you could last year. Now, let me explain how the withholding works, because this trips people up. If you're under full retirement age and you go over that limit, Social Security holds back $1 for every $2 you earn above it. For example, a 63-year-old earning $30,000 in 2026 is about $5,520 over the limit, so roughly $2,760 would be withheld for the year. And now, here's the part that most people, including, again, some financial advisors, get completely wrong. They think that withheld money is gone, lost forever, punishment for working. That is false. Social Security says it plain as day. Those withheld benefits are not lost. When you reach full retirement age, they recalculate your benefit and credit you back for those months. Your monthly check goes up to make up for it. So that fear you've heard, working will kill my Social Security, is actually backwards. The system pays that money back to you over your lifetime through a higher check. But here's the trap, and it's a real one. In the very first year you retire, Social Security can apply a monthly version of the test. So if you earn more than the monthly limit, that's $2,040 a month for someone under full retirement age in 2026. Even in a single month, you could forfeit that whole month's check. Going just $1 over in a given month can cost you the entire payment for that month. That catches people completely off guard. So what should you do? If you're working and collecting, report your estimated earnings to Social Security so they handle the withholding correctly and don't surprise you with an overpayment bill later. You can call them at 1-800-772-1213. Because here's the danger of staying quiet. If you underreport and they later decide they paid you too much, they can demand that money back and even hold your future checks until it's repaid. Your 3-step action plan. Now let's make this simple. I'm not going to give you 10 things to do. I'm going to give you 3, just 3, because 3 is what you'll actually remember and do this week. Step 1. Log in and check your real numbers. Go to ssa.gov and sign in to your My Social Security account, or create one if you don't have it yet. Look at your actual benefit amount and your Medicare Part B deduction with your own eyes. This takes about 10 minutes, and it is completely free. This is how you avoid Robert's confusion. You'll know exactly what you're getting and why. Step 2. Claim your $6,000 deduction. When you file your taxes, make sure that senior deduction is on your Form 1040. If you're doing your own taxes, don't skip it. And if you want a real person to help you for free, call the IRS Free Tax Helpline at 1-800-9069887 or AARP Foundation Tax Aid at 1-888-227-7669. This could be worth hundreds, even more than $1,000 to a married couple. Do not leave it on the table. Step 3. This is the one most people skip, and it's the most important if you're still working. Call Social Security at 1-800-772-1213 and report your estimated earnings for the year. Tell them what you expect to make. If you skip this step and you go over the limit without telling them, they can later hit you with an overpayment notice and hold back your future checks until you've paid it all back. A 5-minute phone call now can save you a very stressful letter later. That's it. 3 steps. Log in, claim it, report it. You can do all 3 this week, and every one of them is free. Before you leave, do me one favor. Drop a comment below and tell me, did you already know about these 3 changes? Just type yes or no. I read every single comment, and I reply to as many as I possibly can. I want to hear from you. And if you have a parent, a brother or sister, a neighbor, or a friend who's on Social Security or Medicare, please share this video with them right now. Seriously, it could save them hundreds of dollars and a whole lot of worry. That share button is right below this video. If you're not subscribed to Retirement Tax and Law Pro yet, hit that subscribe button and turn on the notification bell. I post new videos every Tuesday and Friday, breaking down exactly these kinds of rules in plain English because they change all the time, and you deserve to understand them without the confusion and without the fear. And in my next video, I'm breaking down how your Social Security benefits actually get taxed, the rules almost nobody explains correctly, and the simple moves that can lower that tax bill legally. It affects millions of seniors, and most have never had it explained to them clearly. Click right here to watch it next. I'll see you there.